KYC means know your customer and sometimes know your client. KYC or KYC check is the mandatory process of identifying and verifying the client's identity when opening an account and periodically over time. In other words, banks must make sure that their clients are genuinely who they claim to be. Who uses KYC verification? Ultimately, KYC verification is used by an organization to verify the identity of its customers. Banks, Fortune 500 financial firms, credit unions, credit card companies, fintech, real estate, and insurance companies all use KYC verification. What are KYC requirements? The two basic mandatory KYC documents are proof of identity with a photograph and proof of address. A driver's license or passport are two documents used in KYC verification. These are required to establish one's identity at the time of opening an account, such as a savings account, fixed deposit, mutual fund, and insurance. What is the KYC process in banking? KYC, or Know Your Customer, is a set of processes that allow banks and other financial institutions to confirm the identity of the organizations and individuals they do business with, and ensures those entities are acting legally. OnPassive uses the eKYC electronic Know Your Customer process. What is KYC risk? The KYC risk rating is a calculation of money laundering risk customers might bring to the company. It ensures that organizations don't do business with a person involved in financial crimes, such as money laundering or terrorist financing. The KYC policy is a mandatory framework for banks and financial institutions, used for the customer identification process. Generate revenue and richer engagement by allowing fewer disruptions for your customers. Activate industry-leading solutions to gain a competitive advantage in the marketplace. Accept payments globally. Damage and risk exposure with KYC used by government departments, insurance services, corporate sectors, financial services, and professional services. Know Your Customer or KYC processes help organizations identify and verify customers. By carrying out customer due diligence and identity verification, the risk of unwittingly working with people or organizations involved in illegal activity or money laundering is minimized. What are the four elements of KYC? The KYC policy consists of the following four key elements: customer acceptance policy, customer identification procedures, monitoring of transactions, and risk management. What are the types of KYC? Aadhaar-based KYC, eKYC, offline KYC or in-person verification, IPV KYC. Where is KYC required? By law, KYC is required for financial institutions to establish the legitimacy of a customer's identity and identify risk factors. KYC procedures help prevent identity theft, money laundering, financial fraud, terrorism financing, and other financial crimes. Which year was KYC introduced? The process of KYC and its guidelines were introduced by the Reserve Bank of India, RBI, in 2002. These guidelines are issued under the Banking Regulation Act of 1949. KYC is generally completed by the banks while opening accounts for its customers. OnPassive is using the best KYC. It is using eKYC or electronic Know Your Customer, the no-hassle way of protecting its founders from any financial harm. The O-wallets of OnPassive are the connections to the banks of all founders in OnPassive. Commissions from sales of OnPassive's ecosystem's digital products are placed in the O-wallets and transferred into the banks of the OnPassive founders, using as gatekeeper the eKYC system. No one will be able to withdraw funds but the founders. The process is only one way, meaning the commissions earned are deposited by OnPassive, and only one way out, only by founders. This eKYC is not operated by OnPassive, and OnPassive will not have your private information, only your bank. How sweet is that? Thank you, Mr. Ashma Farah and your technology staff for making this happen.